But here's a tax return of a business we actually sold 2 or 3 times over the years. Good, but a good business. But I use this as a training thing with my brokers when I'm training brokers, because here's an absolute tax return that shows, if you look at the top line, a little over $1 million in sales, and sure enough, look at the bottom line. For tax purposes, this business lost $6,500. They didn't lose $6,500. They lost $6,500 for tax purposes, legal tax purposes. And if I invite you to look at line, I think number 7, compensation officers, was $30,000. And so just looking at this tax return, here's a business that $1 million in sales. As we recast the numbers, the owner had a car they were running through the business, a kid's car they were running through the business, health insurance, life insurance, trips they took, depreciation, add back all of the circumstances that were provable. The actual cash flow of this business was over $100,000. And legally, the owner's paying taxes on $24,000, sub-S corporation. And it made, she had a salary of $30,000 less $6,500 loss, legally paying tax on $24,000, and the business has an owner benefit for the family of well over $100,000. And there's the tax return. Now, if I just sent you that tax return, and you sit on the other side of the computer and say, send me the financials, and I sent you that, so why would I look at this? This lost money. No, it didn't. It lost money for tax purposes. And just like I said earlier, General Electric on $5.2 billion in pre-tax profit 2 years ago paid 0 in taxes. And our new president, Donald Trump, who I like, hadn't paid taxes in several years because it's not profitable. The tax law has got to be rewritten. I'm excited about that. But we have to deal with it as it is right now. And so what people do in their financials, their biggest thing is to minimize taxes except for the cash flow. And what we're interested in is, if I buy this business, how much can I make? And we need the seller to demonstrate that to us. And through negotiations, help end up putting a deal together that works for both buyer and seller. Then we've got something that makes sense for everybody and works.
That's why you always say you've never met an accountant that recommended buying a business.
I've been in business 35 years. I've never once had an accountant recommend anybody buy this. Because if you look at the value drivers of a business, let's just look real quick. Location's a value driver. The furnished fixing equipment that produce that product, that's a value driver. The inventory is a value driver. The trained employees are certainly a value driver. The existing cash flow, the customer base, all of that's a huge value of the business. The lease agreement and different things there, all of those are values, including the financials. When you just look at the financials like an accountant does, or sometimes like a bank does, they hadn't seen the business. They're just looking at the financials. They show a $6,500 loss. Not surprisingly, the accountant's going to say, based on what I see here, I can't recommend you do that. Now, if you want to buy it, I'll say, well, here's what I say as a broker. Look at the gross sales. Look at that top line, doing $1 million in sales. If you run that business right, you should be able to make 10 to 20% on your gross sales. And the seller's representation, provable, they're making over $100,000. But that's pretty good affirmation of what we're talking about there. But if you look at the bottom line, it has no relationship to the value of the business.
Tax return-wise, the unpaid tax is $124,000. That seems relevant.
Sure. We've had a question come in specifically for the slide, so I would be happy if Ed addresses it. And the question is, why does the owner pay taxes on $24,000?
Because if you look at number 7, their compensation to officers, the officers' salary, if you will, was $30,000. What they lost, it's a sub-S corporation, and it lost $6,500 for tax purposes. So they're legally paying taxes on $24,000. And that's just an owner's benefit of well over $100,000. That's the advantage of owning your own business. A lot of times the owner will run their cars through the business, their wife's car through the business, trips they take through the business, sometimes the annual meetings and things. And they expense out as much as they can with pre-tax dollars, not post dollars. And if General Electric can earn $5.2 billion from pre-tax profits and pay no taxes, you see, the tax code that's what it is. So if you got a good accountant, their job is to minimize taxes, not to show how much the business is earning, because you're not selling stock, you're selling the product or service.
Again, Ed, we've had a number of great questions come in. You can just clearly verify, why is the owner's benefit $100,000?
And then, well, and of course, there's a classic example of looking at the top line, not the bottom line. Because her earnings for the last few years have been right around $1 million. So that business is doing $1 million in sales. And you need to sit down with the seller and recast the numbers. And we call recast, we add back the owner's benefit, which would be the
$30,500.
She paid her son $100 a week. He really didn't work there, so we add that back. Sometimes you'll have a family member that used to work in the business. Now they're off at college and they're still getting paid $150,000 a year. So we add that back. So we recast the numbers based on the seller's warranties and representation of how they run in the business.
So in other words, you sit down with the seller and you review all the numbers.
Absolutely.
So when you're recasting those numbers, that means if that business was run professionally,
yep,
or as a public company, you wouldn't put all of these additional benefits that are in theory tangentially.
In fact, even using this same number, let's say that she showed $100,000 in profit, she'd have to pay $35,000 in taxes right now.
Yeah.
And we're doing it this way, she doesn't have to pay any taxes except on that $24,000 component. And that's absolutely the tax code legal.
Of course.
And that's why when looking at a business, when you sit behind your computer, classic example, and say, just send me the last 3 years tax return and let my accountant look at them, and you do not go see the business, you don't know what you're looking at. That's not an accurate portrayal of the correct information as far as the value of that business.
Mm.
What I want to know and what you want to know is what are the earnings of that business. If I buy this business, how much could it make? And I want the seller and the broker to show us that.
Which brings us to our next point, and one of the last points in the process, and that's what are the rules of thumb around reps and warranties of the seller.
This is very important. The closing document that we deal with in this is going to be probably an asset purchase agreement. We normally buy assets for business. We're not buying liabilities. And we're not buying the stock of the corporation like you would with a big business. We're buying the assets. Furniture, fixing equipment, inventory, trademark, trade names, any kind of asset that would be including the name and things there, tangible and intangible assets. But the seller in the closing document is going to make his warranties and her warranties and representations of all the information they provided to the buyer, including the financial information, warranties and representation, survives closing. One of the reasons this deal worked that I had on the screen a minute ago, we negotiated the deal, started off asking $250,000. We negotiated a deal of $190,000 with $90,000 down, and the seller financed $100,000 for 10 years. That's the seller putting their money where their mouth is. And in negotiation of the deal, price, terms, and conditions, the buyer believes correctly that if the seller lend me $100,000, I think she's telling me the truth about what she told about this business. And when you look at it, all of the information is not provided by the buyer, the seller's accountant. The information comes from the seller, who turned in their financial information to the accountant to file a tax return. The three areas of tax return level, you might say. The highest, we have a publicly traded company has an audited statement.
Yep.
And you've got a reviewed statement. We are normally dealing with what's called a compiled statement. In other words, here's all my stuff, my shoebox. I turn it into my accountant and they file a tax return. The only thing I'm interested in is I don't have to write a big check for taxes. An audited statement, all publicly traded companies have an audited statement. Now I caution folks to realize this. Enron had an audited statement. WorldCom had an audited statement. AIG had an audited statement when they were going over the cliff. So did Wachovia. So did Lehman Brothers. Everybody had an audited statement. So just having an audited statement in financials doesn't necessarily equate to value. The reality of the value is going to be a negotiated deal between the buyer and seller in a business that will make you a living. And if you can work out a business that you like, and I think that's probably one of the most important things. If folks can line up what they like to do with what makes them a living, they can get a home run. Mm. You ever see a sports person or a doctor or an athlete or a singer or something that every time they interview them, they seem to like what they're doing? Yeah. That's one of the reasons I think they're so successful, don't you? If you hate to get up and go to work every day, you got a problem, and I don't care what kind of business it is, you see. So look for a business that you like and would be proud to say you own, and see if you can put together price, terms, and conditions through honest and friendly negotiations that work for both you and the seller.
Absolutely. One thing that I want to point out to our potential buyers is the reality, even if the seller starts, I want all cash, I want to get out of the business, in reality, 90% of businesses that are sold will be financed at least in part by the seller. Keep that in mind.
That's the way, and it goes back to the buyer simply doesn't have enough money to cash out. It's not okay, if you want $400,000, I'll give you $400,000. I don't have $400,000. I've got to deal with a down payment that I can pay. There are a lot of small businesses that we cannot get SBA financing, cannot get bank financing. So without that, then the only person logically to finance a business is the seller, which actually is good, because when you look at the reason the bank, two things they got to have is security and proven debt repayment ability. Bank doesn't have security, they can't run the business. They don't understand the financials. Look at the seller. Who knows more about running that business than the seller? So if you didn't pay him, they could take it back over and run it, sell it again. They don't want to, but they could. And as far as the cash flow is concerned, who knows more about the actual earnings, the real earnings, the owner's benefit, than the seller does. So the very fact that the seller will lend you some money on the business, or that they won't lend you money on the business, sometimes tells you more about the business than anything else. So we find, but don't expect the seller to lend you money he hadn't met you. That's again why you got to go see the business, meet with the seller and their wife or husband. And when I go to, I ask my buyer and their wife or husband to come to that meeting after hours. Let them walk you through the business. Look at all the furniture, fixing equipment. Look at the inventory. Let them tell you their story, including, very importantly, is why you sell in this business. What is such a good business? How come you sell it? Most of the time, folks sell the business, they're retiring, the owner's ill, or something that caught cancer, my wife's ill, we're moving back home to take care of mama. Something's come up in there that won't need to sell the business. So let's ask them that. That's a valid question.
Your story needs to make sense.
Yeah.
I wanted just to briefly touch on and provide the information for our buyers. You know, you always say, of course, you can buy an independently operated business, but there's also another option. You can always buy a franchise. So you are an owner of the business, but at least you have some manuals and some backing.
And you've got a proven track record of success. In other words, if you buy a donut franchise, got 2,000 other stores, there's a pretty good chance you open up that store and use that system and name and everything. So now you do have a cost for that on the royalty, but usually the success rate of franchises equals the success rate of an existing business. And incidentally, if you buy a startup, this is a huge difference. A startup business, 60 to 65% of the time is not still in business after 5 years. You buy an existing successful business, and buy it right, or you buy a successful franchise, 90 to 95% of the time you're still in business after 5 years. That's a huge turnaround of risk. You know, and a lot of times folks will use the word entrepreneur. I think that's an overused phrase. An entrepreneur is a risk taker. I don't want to risk. This is my life savings. This has got to work for both buyer and seller.
It has to make sense. We got a lot of questions around sharing additional resources for buyers to be able to help through the process of buying a business. So we just wanted to provide this information. We've provided a link to an amazing International Business Brokers Association where you can find really qualified professional business brokers, and you can reach out to them specifically, especially if you're looking for a business in your specific location. There is another additional resource, and these are small business development centers. They're also local, usually located at local universities in your area. And these are centers that are sponsored by the government, and they have counselors that are specifically trained to work with Main Street business owners and operators, but also they have folks that may be interested in selling a business, or if you stop by a small business development center in your local area, you never know what you may find out, but they're an excellent resource. Likewise, Ed Pendarvis has put out a 12-step process of buying a small business, and you can find that through our premium membership on BizBuySell, where Ed goes through in more depth all the steps that we've gone through. And you can also drill down and get more information through Ed's Business Buyer University. We hope these resources are helpful to you. This is our contact information, mine and Ed's, and the one thing that I can tell you about Ed If you call him, he responds. If you email him, he responds. I don't know when Ed sleeps, but he is absolutely amazing. Feel free to send us additional questions, and hopefully if we get your feedback and we know that what you heard is useful and educational for you, and you want us to drill down into additional topics or specific topics, we're happy to host more of these webinars. Thank you very much for joining us, and we look forward to seeing you again.
Been a pleasure to be with you on the webinar, and let's make 2017 the year that you get in the business for yourself and get a part of the American dream of owning your own business, and make sure it works for you and works for your family. Best of luck to you, and please contact us any way we can help you.
Thank you, everybody. Have a good day.